Hello and welcome to my morning note. Let's go for a world tour today. There's much speculation about a great rotation, about the end of the years of waves of risk on and risk off investment and of a move back to more traditional discerning investment. But if we really are going to have a great rotation, where exactly is the value going to be found? With me now to discuss this is the Global Head of Research for Barclays, Larry Cantor. Larry, thanks very much for visiting us today. Let's start by taking a look. This is a chart from the Barclays Economic Outlook at the quite remarkable real yields or real lack of yields available in the fixed income market. I mean, is this a sign that these trends just cannot carry on much longer?
I think it is. I mean, I wouldn't get too carried away about being able to pinpoint exactly when the turn is, but I think the great bull run in bonds is probably over. It's interesting, we're all used to low interest rates, but what's offset that is continued appreciation in the bonds as yields move lower, and there's just no more room for that. You know, investors are going to have to accept negative real yields if they want to stick with fixed income.
Okay, so now we need to start looking at other asset classes by extension. Let's take a look at a Barclays chart on credit. This is looking at European credit in particular. Has to say it looks here as though this has got altogether too tight. Do you see value in corporate credit at this moment? It's
becoming increasingly difficult. Our credit strategists could find some value in investment grade corporate bonds up until 6 months ago or so, and now they can hardly find anything. Our Barclays investment grade index shows that average yields are 2.5%. They've never been that low. Even in the high yield area, they've gotten down to 5.5%. They're finding some value, but it's getting increasingly hard. And you've got to really look at it closely. You've got to do your research to find value there. Okay, and I suppose the fact that LBOs are suddenly back in vogue is also somewhat of a sign that it's too cheap. That's right.
So now let's take a look at equities then, if we're not comfortable with credit. This is fascinating research Barclays did looking at cyclically adjusted PEs. We've discussed Bob Shiller's work on this very much in the past. This suggests that Europe still has some value.
Yes, as we know, there's been a big rally in Europe ever since last summer, and the reduction in systemic risk around a euro dissolution. But what this chart shows is it's still very cheap. Obviously, the area is still in recession, so there are plenty of risks there. But we do see value there, particularly in the peripheral countries. You know, Italy,
Greece
and Spain.
Is spectacularly cheap on this.
Yes, and we're pretty nervous there. But for Italy and Spain, which are systemically important countries that we think there's just no way they're going to be allowed to, you know, collapse in terms of their debt or leave the euro area, we think there is good value there.
So there is, on that argument, there's still some room for what you might call a risk-on wave back into Europe, that there's enough risk still priced into those valuations, you would say, that that there is value to be had by entering now.
Yeah, I think particularly Italy. I mean, I think there is some election risk here. There's an election within a couple of weeks. But we think Italy's on a pretty good path there. And remember, in Italy, the majority of the fiscal tightening has happened in the past. They've actually got less fiscal tightening going forward. They run a primary budget surplus, so we especially like Italy.
Now, the obverse of all that is that the big emerging markets show up on this measure as being really very expensive, even though they've been fairly unimpressive for the last few years. Does that mean that equities are not the place to play emerging markets?
Yes, I mean, we like equities over debt in the developed world, where these fixed income yields have gotten so unbelievably low as safe havens. But in the emerging markets, we're actually positioned in the opposite way. We like the debt better than the equity for a couple of reasons. One, there's very limited supply on the debt side. Most of these countries haven't run a big budget deficit, so supply is limited. The second thing is there's less room for above-trend growth because these emerging market countries are close to capacity constraints and are worried about inflation, whereas in the developed world, there's plenty of room for growth acceleration.
Okay, Larry, thank you very much indeed. Hope that wasn't too rushed a world tour, but I think the message is, if I could try to sum them up, if you're prepared to take a bit of a risk on Europe, there is arguably some value there. When it comes to emerging markets, you need to think very differently from how you do in the developed world. Maybe credit there makes more sense than equity.